Imagine you run a Fortune 500 company. You just successfully replaced 8,000 human customer service agents with highly capable AI bots.
Right.
Naturally, your immediate next move is to call up your software vendors and cancel those 8,000 user licenses.
Exactly. You don't need them.
Right. And this exact assumption, this idea that AI efficiency strictly equals the death of traditional software revenue, it has erased literally billions of dollars from the market this year.
Been a bloodbath.
It really has. But what if that logic is completely backward? We're looking at ServiceNow today, ticker symbol NW. The stock has taken roughly a 30 to 50% year-to-date haircut, dropping from a 52-week high of $211.48 down to like the $89 to $120 range post-split.
Yeah, massive compression.
Massive. So our entire focus today for this deep dive is answering one fundamental question. Is this violent repricing a structural warning sign of the much-feared SaaSpocalypse? Or is the market just massively mispricing the central nervous system of enterprise AI? Okay, let's unpack this. Because the fear driving the sell-off seems, it's universally accepted on Wall Street right now.
Yeah, the dominant narrative taking hold is that traditional software as a service is just walking into an existential wall. Over the past year, the market has watched these foundational AI models from companies like OpenAI and Anthropic evolve from, basic party tricks into fully functional autonomous agents.
Right.
So the consensus view is that these agents will automate workflows with such extreme efficiency that enterprise headcount is going to permanently shrink.
Which hits the traditional software revenue model directly in the chest. Because, the vast majority of these platforms bill on a per-seat licensing model.
Exactly.
So a reduction in human employees mechanically translates to a reduction in billable seats.
And that right there is the core of the panic. Investors are basically pricing in a world where the fundamental unit of software economics, which is the human worker, is disappearing. And if we look at the value investing analysis floating around the market right now, the bear argument points specifically to ServiceNow's vulnerabilities.
Yeah, the Reddit deep dive we looked at was pretty brutal on this.
Oh, absolutely. You have massive, highly capitalized competitors like Microsoft, Oracle, Salesforce, SAP. They're all aggressively targeting that exact orchestration layer.
Right.
Add to that the vocal critique that ServiceNow's user interface feels, frankly, stuck in 2012. Meanwhile, you have these agile new startups natively building sleek, AI-first platforms from the ground up.
I have to push back here, though, or at least play devil's advocate, because the core logic of that bear case is incredibly compelling.
Sure.
Think about the basic mechanics of corporate cost-cutting. If an AI agent can ingest an IT ticket, diagnose the server issue, and resolve it instantly without a human ever looking at a screen, companies will absolutely reduce their IT headcount.
Yes, they will.
So if I'm an enterprise paying per seat and I just swapped out thousands of human operators for autonomous scripts, I simply do not need those software licenses anymore. That isn't just a cyclical dip. That is an undeniable structural leak in ServiceNow's revenue model.
Well, that argument makes perfect sense. Until you examine the fundamental difference between how an AI model operates and how a publicly traded enterprise operates.
Okay.
Because this is exactly where the contrarian edge lies. Look, large language models are, by their very architecture, probabilistic.
Right. They can guess.
Exactly. They calculate the statistical likelihood of the next word or the next action. But enterprise workflows, things like Sarbanes-Oxley compliance trails, HR data access approvals, cybersecurity incident responses, they must be deterministic.
They can't guess.
They cannot guess. They have to be entirely predictable, auditable, and just locked down by rigid governance.
So the distinction here is that you can tolerate an AI hallucinating a line of code in a sandbox, but you absolutely cannot have an AI hallucinating a compliance approval for like a multi-million-dollar vendor payment.
Precisely. The moment an autonomous agent touches a corporate balance sheet or a sensitive customer database, the liability becomes astronomical. AI does not replace the enterprise orchestration layer. It actually makes the orchestration layer infinitely more critical.
Wow, okay.
You need a highly governed, secure system of record to put basically steel guardrails around these probabilistic models. AI depends on a platform like ServiceNow for auditing, for permissions, for scale.
Yeah.
And, to your earlier point about the inevitability of seat compression,
Yeah.
CEO Bill McDermott revealed a previously undisclosed metric that completely upends that entire bear thesis.
Yeah.
50% of ServiceNow's new business revenue is now non-seat-based.
Wait, 50%?
50%.
So they are actively decoupling their top-line growth from their clients' actual employee headcount. They are effectively charging a toll for the AI's brain power rather than just renting digital desk space to human workers. I mean, they've recognized the shift and swapped a real estate model for a utility model.
That's exactly what they're doing. They're executing a hybrid pricing model that relies heavily on AI token consumption. So as the platform runs more autonomous functions in the background, the enterprise burns more tokens, which drives up consumption revenue, regardless of how many humans are actually logged in.
Okay, but if that structural pivot is actually working and the whole SaaS apocalypse narrative is just a market hallucination, it has to show up in the hard revenue numbers.
Right, numbers don't lie.
A narrative without financial gravity is just a story.
Yeah.
If the model was actually collapsing under the weight of AI, the bleeding would be super obvious in the order book. So let's look under the hood of their Q4 2025 earnings data.
Let's do it. Because the actual financial reporting provides a stark, I'd say almost jarring reality check against the market panic.
Yeah, I'll run through the hard data here because it directly contradicts this fear of a mass exodus. Q4 subscription revenue hit $3.47 billion.
Which is up 21% year over year.
Right. Current remaining performance obligations, CRPO, which represents cash already contractually committed for the next 12 months, jumped 25% to $12.85 billion.
That's massive.
They closed 244 new deals, over $1 million in net new annual contract value in the fourth quarter alone. And their renewal rate held at an elite 98%.
Consider what a 98% renewal rate implies mechanically.
Right.
They're operating on a base of 8,800 massive customers, encompassing like 85% of the Fortune 500. Maintaining a 98% retention rate at that scale completely shatters the idea of AI startups coming in and eating their lunch.
Definitely.
Furthermore, regarding that seat compression myth we just debated, the earnings call highlighted a metric that Wall Street seems to have ignored completely. Monthly active users actually grew by 25%.
See, that is the ultimate divergence to me. Instead of abandoning the platform or shrinking their user base as they deploy AI, these enterprises are actively adding users and expanding their daily footprint inside the system.
Yes, because deploying enterprise AI requires more humans in the loop for oversight, for review, and strategic management, not fewer. The C-suite wants the predictability and the governance that ServiceNow provides.
Right.
And their proprietary AI product suite, Now Assist, is completely validating this demand. The annual contract value for Now Assist just surpassed $600 million, and it's tracking aggressively toward $1 billion in 2026. Deal volume for their AI Control Tower products nearly tripled quarter over quarter.
So if you're managing a portfolio right now, you really have to reconcile this. We are looking at a stock that was punished with a 30 to 50% haircut, yet the underlying order book is generating 25% growth in guaranteed future cash.
The takeaway here really relies on understanding enterprise buyer psychology. Chief information officers and CSOs, they are the most skeptical, highly informed, process-driven evaluators of software value on the planet.
Absolutely.
They do not authorize massive, multi-year, multi-million-dollar contracts on platforms they believe will be commoditized by some new OpenAI update in 6 months.
Right. They aren't stupid.
Exactly. If a CIO signs a 3-year ServiceNow contract, it's because ripping out that infrastructure is closer to performing a heart transplant on the company than it is to just canceling a software subscription.
Yeah.
It requires retraining entire global teams and completely redesigning regulatory compliance from scratch. The order book is winning on the ground, even if market sentiment on the screen is lagging.
Which sets up a massive logical bridge for our analysis here. We have elite fundamentals. We have 98% retention. They are beating their own revenue guidance. And most importantly, they generated a massive 57% free cash flow margin in Q4.
It's incredible.
A stock with those metrics should be flying high, yet it is trading like a distressed asset. What is the market seeing in the valuation that we aren't?
Well, the valuation compression is undeniable.
Yeah.
Over the past 5 years, ServiceNow's price-to-earnings ratio held a median of 150x.
Right.
It has been violently compressed down to 53.8x trailing, with a forward PE of just 21.5x. Looking at the Guru Focus models, the stock is currently trading at a 58.9% discount to its calculated intrinsic value of $218.33.
Wow.
Yeah, the quantitative models categorize it as significantly undervalued.
But we have to apply rigorous valuation discipline here and address the primary bear argument regarding that cash flow. We really have to talk about the elephant in the room, stock-based compensation, or SBC.
Yeah, the SBC critique is highly valid, and it is exactly what sophisticated analysts stress test when they're evaluating tech valuations.
Well, let's lay out the math for everyone. The company reported a pristine 35% free cash flow margin for the full year, representing $4.64 billion in free cash. It looks incredible on the headline.
Right.
However, their stock-based compensation was $1.955 billion. That is roughly 15% of total revenue. If you strip out that stock-based compensation to find the true cash yield, the actual free cash flow yield drops to under 2.5%. That is the core vulnerability here. Are we looking at a pristine cash machine, or is this basically the equivalent of a restaurant claiming record profit margins simply because it pays all its top chefs and company IOUs?
Look, high SBC artificially inflates top-line free cash flow by substituting actual payroll expenses with shareholder dilution.
Right.
It is a legitimate drag on the real cash return to investors. However, looking solely at the SBC expense completely ignores the aggressive, mechanical counter-moves management is executing to neutralize that exact dilution.
Okay.
These moves signal massive insider conviction that the current stock price is just irrational.
Yeah, right in the middle of this software sell-off, top executives at ServiceNow did something you really rarely see when a company is supposedly facing an existential threat. Several key leaders, including the CFO and the chief people officer, legally canceled their pre-scheduled 10b5-1 stock sale plans.
And understanding the mechanics of a 10b5-1 plan is crucial here. These are blind trusts set up by executives to automatically sell small portions of their stock at regular intervals.
Right, to prevent insider trading accusations.
Exactly. By legally revoking those plans, these executives actively lock themselves out of selling their shares at these depressed prices. And CEO Bill McDermott went a step further, deploying $3 million of his personal wealth to buy shares on the open market.
Which is huge.
Analysts flagged it as one of the first aggressive insider buying signals across the entire software sector during this tech rotation.
But I mean, insider buying, even with personal funds, is ultimately just a confidence signal.
Sure.
Confidence doesn't fix the balance sheet. What about the actual financial engineering required to offset the dilution from the SBC?
Well, the board authorized a highly aggressive capital allocation strategy, a $5 billion share repurchase program, highlighted by an immediate $2 billion accelerated share repurchase, or ASR.
Okay, break down the mechanics of an ASR for us, because it operates very differently than a standard corporate buyback program.
It does. In a standard buyback, a company slowly trickles into the open market over months or years to buy its own shares, hoping to slowly support the price. An accelerated share repurchase is a highly aggressive financial maneuver.
Right?
The company hands $2 billion in cash directly to an investment bank. In exchange, the investment bank immediately delivers millions of borrowed shares to the company, effectively retiring them up front.
Instantly.
Instantly. This entirely reshapes the balance sheet. By permanently shrinking the overall share count overnight, it artificially and mechanically forces earnings per share upward, because the company's profits are now divided among a much smaller pool of outstanding shares.
Makes sense.
It acts as a direct mathematical offset to the SBC dilution and signals that the board views their own stock as the highest yield asset they can possibly purchase.
Okay, so financial engineering sets a hard floor on the stock. It protects the downside. But defensive maneuvers and buybacks, they don't create massive multiple expansion. To break out of this $100 range and run back toward previous highs, there needs to be a forward trigger. And that shifts our focus strictly to their catalyst discipline and their recent M&A strategy.
Right, because over the past year, ServiceNow went on an acquisition spree that genuinely spooked the market. They announced a $7.75 billion acquisition of Armis, which is a company specializing in IoT and operational technology device discovery.
Yeah.
They bought Visa for identity security and MoveWorks, which operates as an AI front door or reasoning agent.
And the market reaction to that capital deployment was brutal. I mean, they penalized ServiceNow, erasing nearly $10 billion in market cap, because the prevailing narrative was that McDermott was desperately buying growth.
Right, that was the fear.
Investors just assumed the core orchestration moat was dying, so management was panic buying security companies to prop up the top-line revenue numbers.
But McDermott directly confronted this narrative on the earnings call. He stated definitively that the large-scale M&A phase is over.
Which is a big relief.
Exactly. But more importantly, he clarified the strategic intent. They did not buy Armis or Visa for top-line revenue supplementation. They bought them for deep architectural capabilities to capture a $125 billion security total addressable market.
Okay, but connecting device discovery and identity security to an AI growth thesis isn't immediately obvious. How do those pieces actually fit together?
Consider the massive new problem enterprises face with AI deployment. Autonomous agents exponentially expand a company's attack surface.
Oh, sure.
If you have AI bots navigating your network to optimize supply chains or manage IT infrastructure, you need absolute visibility. You need to know exactly what hardware and digital devices exist on your network, which is a capability Armis provides.
Right.
You also need to know exactly who and what AI script has permission to access sensitive data, which is the capability Veza provides.
Let's ground this with a concrete scenario, because it's a lot of abstract tech jargon. Suppose an enterprise uses an LLM to write a custom deployment script, but the AI hallucinates and writes malicious code that accidentally opens a critical firewall port.
Okay, in a standard environment, that vulnerability sits there until a human auditor catches it, or worse, a breach occurs.
Right.
But with this new architecture, Armis instantly detects the anomaly on the network device. Veza immediately identifies that an unauthorized script is attempting to alter identity permissions.
And then ServiceNow steps in.
Exactly. ServiceNow acts as the central orchestration layer, ingesting that visibility and triggering an automated protocol to instantly quarantine the script and revoke access. They are building what they refer to as the AI control tower.
So they are essentially positioning themselves as the air traffic control system for a massive fleet of autonomous AI drones.
That's a great way to put it.
And this thesis aligns perfectly with their strategic partnerships, too. They aren't burning billions trying to build a better foundational language model than OpenAI.
No, they don't need to.
They are agnostic infrastructure providers partnering with everyone. I mean, they expanded their partnership with Anthropic to embed the Claude model for complex coding agents. They partnered with OpenAI for real-time voice and multimodal capabilities within their CRM suite. They even integrated deeply with Microsoft 365.
And this is the ultimate catalyst for anyone evaluating this company. ServiceNow is evolving into the semantic layer of the enterprise. They are engineering the governed, secure, deterministic workflow environment where all these incredibly powerful yet probabilistic LLMs are legally and safely permitted to operate inside a Fortune 500 company.
Right.
The hyperscalers and AI labs, they provide the raw computing power and the predictive models. But ServiceNow owns the actual workflow layer where the business decisions are executed, recorded, and audited.
Okay, let's bring this all together. The market consensus, deeply gripped by the SaaSpocalypse narrative, is aggressively pricing ServiceNow as a primary victim of AI seat compression. Wall Street basically sees a traditional per-seat licensing model about to be automated out of existence. But the raw data, the 25% growth in monthly active users, the 25% jump in committed future cash, the 98% retention rate, and the massive structural shift toward charging for AI token consumption, it reveals a completely different operational reality.
A completely different world.
ServiceNow is a highly sticky, deeply embedded infrastructure layer that is successfully monetizing the AI revolution. It really operates as the central nervous system for enterprise automation. Furthermore, management is aggressively taking advantage of the market's panic, using a $5 billion buyback program to mechanically boost EPS and offset those dilution concerns.
It represents a classic, massive divergence between the dominant market narrative and the underlying financial gravity of the asset.
Certainly.
But as we look forward, consider the broader implications of this technological shift. As the global corporate race to replace human workers with autonomous AI agents accelerates, the ultimate corporate liability is going to shift. It won't be human error anymore. It will be unchecked, high-speed AI hallucinations. If a completely autonomous AI system makes a multi-million-dollar error like incorrectly routing a massive supply chain order or granting unauthorized security access to a sensitive database, who audits the bot?
Right. Where is the immutable paper trail to prove to regulators that the enterprise actually had control over its own systems?
Exactly. The platform responsible for monitoring, securing, and providing an unquestionable audit trail for those AI agents suddenly transitions from just an IT management tool into the single most mission-critical piece of software in the entire enterprise.
If you remember one thing, it's this. The market assumes AI is knocking down the software industry. But the data shows ServiceNow is rapidly becoming the foundational infrastructure making enterprise AI legally and functionally possible. In a market driven by narrative panic, your ultimate edge is always cutting through the noise and looking at the raw operational data. Until next time.